Good day, everybody, and thanks for joining us for the Nedgroup Investments Rainmaker and Entrepreneur Second Quarter Fund Updates. My name is David Levinson, Senior Investment Analyst at Nedgroup Investments. And today I'm joined on the line by Anthony Sedgwick, Portfolio Manager of the Rainmaker and Entrepreneur Funds. Anthony, thanks for joining us today.
Thanks, Dave, and thank you. Good morning, everybody, and thanks for the opportunity and your interest.
Thanks, Ant. This is our second attempt to host this call, so apologies again for last week. So far today, it looks like the technology and load shedding guards are on our side. Before I do hand over to Ant, a quick reminder of the Q&A function on the right-hand side of your screens. So please feel free to type away and I'll pose those questions to Ant at the back end of the presentation. And if you have joined the call as anonymous, please do type your name in the Q&A function so that our team here has it on record for CPD purposes. As always, the session is being recorded and will be available shortly after the call, so please do feel free to revisit it again or forward on to your clients. For the quarter just gone, the Rainmaker Fund has performed largely in line with the all-share index, recovering a large portion of the downside experienced during the month of March. And of course, the Entrepreneur Fund has performed at the top end of its CISA category, although the mid and small cap stocks have felt the full force of the COVID virus and the subsequent lockdown here in South Africa. But of course, who better to hear from Ant himself? Ant, I'd now like to pass over to you. Thank you.
Thanks, Dave, and good morning again, everyone. We've got half an hour, and if you think about what's happened in the last quarter, a great deal. So I'm going to move through quite quickly. We've covered some of the matters in a little bit more detail in our quarterly commentary, which hopefully will be out and available quite shortly. And but let's get into the slides. The first slide is just showing the all-share index in context, looking back 10 years, and the red line showing where we've been moving sideways since mid-2014 and trapped in that band between about 50,000 and 60,000. Obviously a frustrating and tough time for South African domestic investors, and you'll appreciate that within that period, there've been a massive divergence in returns between different sectors. Clearly showing also the height and the extent of the fall. I think you may have read many commentaries, and you'll be aware that the impact of the COVID-19 crash in the context of historic major market corrections was the fastest on record, and quite clear to see the tremendous recovery that we've seen in a very short period of time. So very, very volatile year so far, 2020. If you look at the year-to-date numbers, massive divergence again in relative performance between our resource stocks and industrials. Of course, the industrials driven mostly by some of those big, large rand hedge stocks, particularly Naspers and Prosus, which I think you'll know dominate our index now. And then in contrast, bringing up the rear are the financials, with the banks and the property companies particularly hard hit. If we move to the next slide. So if we looked at Rainmaker, what worked and what didn't work, we have an enormous exposure to the Naspers Prosus combination, which is effectively our interest in Tencent, the Chinese technology business. It's now over 20% of the portfolio. We have started to take a little off the table, but we're still extremely positive about the prospects for that business. I'm happy to talk in more detail. There is a short comment in the quarterly commentary specifically on this exposure in the portfolio. BAT and Rainet, which have pulled back a little bit in the short term, cumulatively about 10% of the fund, have worked very nicely. Our resource exposure, where our preference here is the diversified mining houses, Anglos and BHP. Collectively, they're over 10%. Those two holdings together are over 10% of the portfolio, where the prospects for iron ore and copper, in particular copper in the short term, look very attractive, and the relative valuations of the diversified mining houses to us is more attractive than the mining producers in the PGM and gold mining side of things. Having said that, we think that the tailwinds behind a relatively strong gold price, given the political developments around the world at the moment and the deterioration in diplomatic relations, combined with very, very low interest rates all over the world, remain supportive of a stronger gold price. And Anglo Gold for the first time in many years, has been a top 10 position in the fund for about the last 6 months, about 4.5% of the fund. And we do own some PGN producers directly. In fact, we own all of them collectively. They're about nearly 4% of the fund. We own almost no REITs or property stocks. Only position is a 1% holding in Growth Point. And we're very, very cautious on discretionary consumer, where retail is a very, very low proportion of the portfolio. What has hurt is our banks exposure. We thought that the banks going into the crisis, that their balance sheets were in a far better position than they were at the time of the global financial crisis, and they have underperformed. Of course, it's a very, very tough time for these businesses, and it does remain a bit of a worry. We've had some exposure to Sasol, which in the first quarter really hurt us. I'm proud to say we stuck to our guns there. We even bought some shares at around 40 Rand and watched it go to 20 first. And of course, it's seen a substantial recovery since. We think at about 175 bucks, it starts to look quite full, and we have been lightening at that point. And some select domestic industrial exposure that we have has also hurt a bit. What have we been doing during the crisis? We've been pretty active, I can tell you. The early analysis, thinking back to January, February of this year, which today seems a lifetime ago, was initially that it was a relatively unimportant thing. We'd seen these sort of things before with the SARS and bird flu. We quickly started to worry, though, that we didn't want to make the mistake that we did a little bit at the time of the global financial crisis, of thinking that something that was a localized American credit situation, snowballed into something that affected the global situation, and we were very concerned that could happen, and that has largely come to pass. We spent a great deal of time and effort understanding the effectiveness with which lockdowns may or may not work, and the impact that would or wouldn't have in the short and medium term on economic activity. Then it came a deep understanding of trying to appreciate, given the degree of economic stimulus, both fiscal and monetary, that's been applied to every economy in the world, the extent to which that would offset the impact of the economic crisis caused by the pandemic, and then starting to analyze how consumer behavior and economic activity, once we all emerge from a lockdown type environment, may be permanently changed as a result of the event. We also had to respond to the very rapid economic impact and liquidity concerns, and that varies from company to company and industry to industry. So our focus has been very hard on balance sheets, cash flow, and business resilience. And then, of course, within that, the context within our South African market between our international businesses, which is a big part of the market, versus our domestic businesses, constrained by the South African economy and their ability to bounce back. So what have we been doing? The first thing is we've maintained our Rand hedge exposure as much as we could, unless we had concerns about the underlying prospects for the individual businesses, and that their valuations were very firm, were very high. So in that regard, for example, we have sold out completely of Richemont and Bidcorp and substantially reduced our AB InBev exposure. Mondi and Sappi were also substantially reduced. We've looked into increasing stakes into cyclical South African businesses and more defensive South African businesses. So on the cyclical side of things, we substantially increased our mining exposure, where we saw the Chinese economy and its response being very supportive of our positions in BHP and Billiton, and we added to our gold and direct platinum exposure. Our focus has been on balance sheet and an opportunity to acquire quality at a discount. So within the banks, we've seen some rotation where we held all of the banks, where we felt there was great value across all of them, but all have fallen by similar amounts. We've used that opportunity to rotate into the higher quality. So we've maintained our overall banks exposure, but we've reduced ABSA and increased the exposure to First Rand. And we've looked to also balance that with some investment into stocks that we thought were particularly oversold. A good example there would be AVI, which is a high quality business. We had an opportunity to get some exposure to Santam. We think the business interruption insurance issue that people are panicking about at the moment is totally overstated. And we think it's a great opportunity to buy a very, very high quality business at prices we haven't seen in about a decade or so. Just a couple of comments on the South African economy, which apply both to Rainmaker and Entrepreneur. This is a slide that I've shown at several presentations we've done. So at the risk of boring you all, I'm just putting it up to the bottom left is GDP growth in South Africa, where the red line is 0. And you can see I've just put in the, we don't know, but if you listen to what economists are saying, we're going to be down somewhere between 7 and 10% on GDP growth for this year. And the bottom right-hand side is business confidence, which has dropped to a previously unrecorded low. The previous ever recorded low was, I think, 12 at the time of the Sharpeville riots in 1976. The number is now 6. So particularly for domestic stocks, the kind of points that we would be looking for to say now is the time to start rotating and buying because the prospects are starting to improve for our domestically oriented businesses. Are the 4 points are listed on the bullet points above them. And unfortunately, for many of these now, for the last 5, 6, 7 years, the situation has remained poor. And despite the change of leadership at the head of the ANC to somebody who has a far deeper understanding of the economic environment that we need to prosper as a nation and a country and for business to flourish, we all know that very little progress has been made. Unfortunately, the onslaught of COVID has set us back even further. And the South African economy, we worry structurally, its structural ability to respond through stimulus and to recover is extremely constrained and limited. This is an update of just the valuation across the different sectors, from the large caps to the mid caps to the small caps, where you can see our market has, despite the fact that we've had very little growth, with the market moving sideways for the last 6 years, the market has derated from around sort of 15 times historic earnings to pretty much single digits. As the title of the slide suggests, of course, looking at P's at the moment is from an historic basis and even a forward basis is a largely irrelevant thing because there's so much uncertainty and so little confidence one can have about accurate forecasting on levels of profitability for large companies and small companies. So our focus has been on cash flow and balance sheet strength more than looking at an absolute level of earnings or dividend yield. Just to show you how dire the situation is, this may be slides that you've seen before, is the chart on the left shows interest payments. This is for the South African government's balance sheet. That interest payments as a percentage of gross tax revenue have increased from 8% to 15%, and the latest forecast suggests this is going to 20%. So whereas we were spending less than 1 in 10 rand of our revenue on paying back interest and debt, we're now spending 2, and of course that has to come from somewhere. In an economy that's not growing, that every rand extra that we have to spend servicing debt has to come out of the mouths literally out of the mouths of school feeding schemes, healthcare, security, education, and social grants even. But you'll know that in the state that we're in, that there's very little desire and very little conviction to achieve any kind of cost cut. It'll be interesting to see, now that we apparently have secured IMF funding, what the conditions attached to that are, and we can only hope that the IMF has put stringent conditions that will force the South African government to be a little more prudent around expenditure behavior. And I'm sure you've seen this before from some of my clever colleagues who follow the bond market more closely, how our debt to GDP ratio, now heavily impacted by the COVID-19 crisis, will cause debt to GDP to accelerate to very worrying levels. And this is an inevitability, not simply projections. Just a last slide on Rainmaker before I quickly turn to Entrepreneur for a couple of comments. That just shows you the top 10 holdings. So you can see Anglo Gold right up there and easily into the top 10. I think we've discussed most of these positions. The pie chart on the right will show you that between basic materials and industrial rand hedges, more than 55% of the portfolio is now what could be broadly described as rand hedge. You'll notice quite a big exposure to financials, and we've discussed our bank position, which we're patiently holding on to, whereas domestic consumer is a relatively small portion of that pie. A couple of comments on Entrepreneur. Very similarly, our principle has been to adopt a conservative stance in a worrying environment. We think short-term insurance has a very powerful ability to weather the storm that we're going through. So our position in Santam and RMI, which is an indirect exposure to outsurance, is 10% of the fund. We've got more limited ability to get rand hedge exposure because the big miners are not available to us, and obviously the large cap rand hedges, but we have a very healthy exposure there through Naspers, BAT, Rainet, Oceana, and some mining exposure. Very interesting to see that there is clearly value in the mid and small cap space, where we're seeing some opportunistic M&A activity. We've already been bought out of Assor. Our Peregrine position is going through the process of a takeout. We've seen a bidding war going on for Quantum Foods, which is a small egg producer, which we don't have exposure to. And we would expect that there's likely to be more of this kind of activity in the space, and we would hope to benefit from it. Again, our focus here has been on balance sheet, an opportunity to acquire quality at a discount. AVI and Adcock are both positions we've added to, and they are both around 4% weightings in the portfolio. Once again, here we have very limited exposure to discretionary consumer, where we're quite worried about the prospects in the medium term for those businesses. So in that respect, we've reduced our exposure. We sold out of Truworths completely and reduced Italtile, despite the fact we think that's one of the best quality businesses on our market, but clearly very exposed to a discretionary consumer type activity. And we bought some Pick and Pay, which we think is more defensive for the first time. We've sold out of Barlow's, but I am a bit worried about our exposure, even though the valuations are very compelling, to CMH, Udeco, and Reunert, being domestic industrially exposed businesses. Collectively, though, they're less than 10% of the fund. So if you look at Entrepreneur's positioning, the table on the left shows where we were at the end of February. The table on the right shows where we were at the end of June. You can see we've sold out of WBHO, Barlow World, and substantially reduced the Italtile, which were all top 10 positions only a few months ago. And in contrast, you can see the substantial increase in our exposure to Afrimat, which is essentially an iron ore producer, RMI being outsurance, and AVI coming up through the ranks. Adcock Ingram, you can see, has risen up as well, is now the fourth biggest position. The last point I'd like to make is I thought about the fund from this perspective a little bit, where if I went through each of the holdings and I looked at ones to say which would be relatively more resistant to the impact of COVID, which are potential fatalities, businesses that could actually be completely killed by the virus and the impact it had on their commercial viability, and those that had been hit quite hard, valuations were very attractive, but were unlikely to fail and could snap back very quickly if we got a little bit of economic growth going in South Africa. And those I've called COVID recovery. And I've given you an example of the kind of businesses that I would see in those three different categories. You can see COVID resistant collectively was 42% of the fund at the end of February. It's 67% on the 20th of May, which is only a couple of months ago, but won't have changed substantially since then. whereas the COVID fatalities we had reduced substantially from a quarter of the fund to less than 13%. And some of those names today aren't even there. And then from a COVID recovery perspective, while we worry about these businesses and so had reduced our exposure, we do still have some reasonable exposure there. You can see we've run down the cash as well from 9 to 4%. We've managed to weather the storm relatively well in comparison to the benchmark indices, hoping to benefit from the ongoing upside, and pleased to see that the performance of the last year relative to the peer group looks pretty attractive. So I'll stop at that point. Hope that's been helpful and answer any questions you may have.
Thanks very much, Ant. That was very comprehensive. We have had quite a few questions come through, some of them more macro focused and some more on some of the specific holdings within the fund. So I'll start outward in. The first one is around the gold price. So gold having reached new highs, I think it's about $1,800 today. Your gold exposure has been mainly through Anglo Gold, and I see you have added some in the last quarter as well, which I imagine you have rather a not so much as bullish, but your view is the gold price should remain elevated for some time. Is that a correct assumption?
Look, gold is a very, very difficult thing to predict. So we wouldn't be wanting to stake our reputations on knowing exactly where that's going to do. All I would say is on our balance of probabilities way of investing, which is a phrase you've heard us use many times before, given the political deterioration of relationships around the world and the state of very low inflation, we would say that that's more likely to favor a higher gold price than a lower gold price. Combined with, given the macro environment in South Africa, more likely a weaker rand than a stronger rand over the medium term. These, the gearing to the profitability of these companies is extremely high, and we prefer Anglo Gold, despite its relatively shorter resource life in comparison to the others, because its production isn't hedged, whereas all the others do have their production hedged to varying degrees.
Thanks, Ant. And then I'm going to try and morph two questions into one here because they both seem to focus a little bit on China. So China obviously have recorded a positive PMI print as well as GDP recently. And the first question is around the fact that you hold rather sort of material positions in some of the diversified miners like Anglos and BHP. How correlated are those now? Are they still highly correlated to the Chinese growth story? And then the second question is around sort of Naspers in process, making up, I think, just south of 22% of the fund, and whether you view this as being too large or sufficient in your view.
So the second one is quicker. So I would say it's at the extreme end of our risk tolerance. Where in all likelihood, we'll look to talk to my clever colleagues across the room here around putting some protective hedge structure in on that position. We're still extremely confident about the growth prospects, and Tencent, if you strip out the value of their portfolio investments that they have, is not trading. It isn't actually as expensive as it may at first appear, and you combine that with the fact that Naspers is trading at a record discount to NAV, leaves you thinking, well, in comparison as a South African investor to a domestic industrial stock, it's still infinitely more attractive. On the BHP Anglo's perspective, yes, certainly still very correlated to the Chinese growth environment. There's been tremendous stimulus applied there, particularly on the infrastructure side of things. And we learned in 2016 that you underestimate the Chinese ability to inflate their own economy at your own peril. And certainly if you look over the last little while at the price performance of iron ore and copper, it's very supportive of those positions, but we're obviously watching it very closely.
Great, thanks, Ant. And then another question we've come through is how long before SA markets are normal again? My gut feel is this is quite a binary question in the sense that you have your local and your offshore earners that behave rather differently.
Yes, and I think that's likely to become even more so.
Okay, and then looking at some of the stock-specific questions, we've had one come through on some of the consumer-facing stocks. So I know you did trim or at least sell your Woolworths position and prefer now Pick n Pay and Spar? Maybe you can talk to some of that rationale and how those earnings are holding up during the lockdown.
Yeah, thanks. So we don't own any Woolworths. We did buy some opportunistically. It was a small position, but we've sold it out all again subsequently. We've already had one meeting with the new chief executive, who seems to be an extremely impressive guy with his hands around and a deep understanding of the situation that they're dealing with. But it's a business under tremendous pressure, whose balance sheet is really in a dire state. And under these circumstances, I don't think you want to have it's needless to take risk with respect to anything that's got a very weak balance sheet. And you can see we've now had Truworths announce, Pashini announced yesterday their rights offer. Businesses even more dire state like City Lodge and Sun International. We expect that there will be more to come. So we just don't think it's worthwhile taking any of those sort of chances. In comparison, Spar is a very steady business. Sadly, its liquor business will be taking a little bit of will have a bad weekend of trade this weekend, but that won't last forever. It's more where it is internationally diversified. The growth prospects actually for those businesses have got better, specifically in Switzerland, where people would typically live in Switzerland but shop in France are now having to shop in Switzerland. So that's been very helpful for them, and of course the relative valuation is pretty compelling. So we own Spar and in Rainmaker and Pick n Pay in Entrepreneur in preference to Woolworths and Shoprite for that matter.
Thanks, Ant. And then another one closely linked to the SA local story is Advotech. So the question you've come through here is, can you expand on your views around Advotech and it falling into the COVID fatality category?
Yes. Look, this is I think the most fascinating thing is going to be to see how education and the provision of education, both secondary and tertiary, is going to change, not only in South Africa but in the whole world in a post-COVID environment where it already had been moving. And we're really spending a lot of time looking for opportunities, particularly in our global fund, around that theme. Advotech is a great business. I really like the team that are running it. It doesn't have a balance sheet that's in particular distress, whereas Curro has got a very overextended balance sheet and is now having to have another rights offer. But that was certainly to be expected. Advotech has faced the headwinds of immigration, and they've highlighted this very clearly for the last 3 years around the impact that has. Now, with schools and university and tertiary institutions, once one reaches a certain level of occupancy, you go beyond that point, the rate of profitability increases quite dramatically. Advotech have run a pretty tight ship for a long time, but they've been highlighting the impact that immigration has had in reducing and caused them difficulty with respect to maintaining the level of profitability. Our concern is that that the level of enrollment and with the inevitable pressure that households around South Africa are going to face is and with many people having to resort to home-based education, which may be more cheaply available, what that means for their enrollment numbers. And as a consequence of which, while we do still have a small position, we're quite worried about the private education providers and their ability to weather the next year or two.
Thanks, Ant. And then we have had some come through on some of the global stocks, again around Naspers and Tencent, which we've touched on briefly already. We did send out a communication last week on the exciting evolution of the Rainmaker Fund, and we will be hosting a more in-depth call with yourself and the team at Abax in the coming weeks for clients to dial into. So just on the global front, we did host our emerging markets manager yesterday, and he was very bullish and excited about emerging market equities relative to the developed world. And maybe looking at your global strategy, which you mentioned in the previous question, some of the key holdings that you've held there that you feel the investment case still holds and you'll be holding for some time.
Yeah, so I think it's a fascinating thing to consider in that respect, where in the world today you have these two giant economies, the United States and China, which completely dominate, the growth opportunity and completely dominate global economic activity. I mean, it's fascinating for me to see that in 2000, I think it was, South Africa was, I think, 15% of the MSCI Emerging Market Index. We're down to like 4 or 5, and if you strip, we're just becoming completely irrelevant in the global context in comparison to China, which I think is now 40%. So I share that gentleman or lady's enthusiasm for EM, but I think it's very clearly one needs to understand what the underlying drivers of those are. So EM as a whole, is a massive difference. I was reading a fascinating document yesterday just about the relative appeal of China versus Brazil versus Russia versus South Africa or Korea, and Turkey, of course. So we're if I look at our global fund and the opportunities, I would say the vast majority of the excitement is around American and Chinese businesses, with a sprinkling of a few in Northern Europe that are actually more global businesses, with very little beyond that general scheme, that general area.
Okay, thanks, Ant. We have gone slightly over time, and that's all we have time for today. So thanks again for joining us and your input today. I'm sure everybody found it very insightful.
Thanks for the opportunity, and thank you all for your support.
And of course, for the clients out there, if you have any further questions, please do get in touch with your Nedgroup Investments Relationship Manager. And of course, the team at Abax are always open and very happy to chat with us as well. So from myself and Ant and everybody at Nedgroup Investments, thanks for joining us this morning, and have a good weekend.